Well, I love my job, and I love it because I get to speak to interesting people like Kokkie Kooyman all the time, but not often, in fact, never in like 40 years have I spoken to someone who is where Kokkie is today. He's going to show us in just a moment. All right, Kokkie, you got to just take your camera and show us a little bit around the place that you're at, and somebody watching this can guess before we actually disclose your venue.
We're in a small hotel outside the airport in the middle of Greenland somewhere, and this is the view from outside my the window where I'm sitting, and so you can see the snow, and that's. If you look good, you can see the airport tarmac just behind us. So you get off the plane, take your luggage, and then walk to your hotel. And it's like being back in the army. But I must say, it's everything is very well constructed. It's warm. Inside, obviously, they took us onto the Arctic, the polar cap ice pack. Walk there, ice cap, not ice pack, ice cap. It's stunning. Today we're going dog sledding, so this is something I've been looking forward to for a long time.
And here I am interrupting you, but I think it's for good reason, because we've had two very important sets of results in South Africa. BizNews portfolio members that there's no one better to help us through understanding that. And then, of course, we've got Silicon Valley Bank. And just by way of background, when we started BizNews as an international adventure, we were based in London and then had an option of Silicon Valley Bank or Metro Bank. And we went with Metro Bank, thank goodness. I remember Metro Bank had been recommended by Gerrie Fourie of Capitec. He said that they want to be as good as them one day, and not going with Silicon Valley Bank. And I'm quite grateful about it. Just maybe give us some background on why the Silicon Valley Bank collapse. It's only the 16th biggest in the US, but why the collapse has reverberated so?
Look, and it was the second largest collapse in the US since Washington Mutual in 2008. So it is quite significant. But Alec, the big problem is one has to go back to the excess liquidity that was created by the Fed post the March 2020 COVID lockdown. And they also continued the QE program, lowered interest rates, flooded the system, and the US government flooded the system with PPP checks to help unemployed people or people suffering from COVID. The bottom line is that banks were flooded with deposits. All this excess money didn't go back into the economy. It went into the banking system, and it then really drove up the prices of profitless tech, as it was called, of the whole crypto bubble. That was all fueled by that money that was created by the Fed. The Silicon Valley Bank was at the center of this in Silicon Valley, that and Silvergate. So it was a huge recipient of all those deposits, all the SPACs. All the private equity firms parked their deposits with Silicon Valley because they were entrepreneurial. They were actually a very good bank at doing in what they were doing. You could almost think them in terms of entrepreneurial spirit was like an Investec in South Africa. So entrepreneurs love parking money with them. The result was that they had one of the highest concentrated deposit bases in the US. In fact, 55% of their asset base was government securities, 35 loans, because those deposits they couldn't lend out immediately, and they parked that in government securities. And so you can see how the government securities dwarfs their loan book. But now here comes the problem. They did a few things wrong. One, because the yields then, remember we're talking 2021, the yields then were low, and they wanted a slightly higher yield, they were greedy, and they parked it in longer dated securities, so longer dated bonds, which were then yielding just over 1%. Yields have gone from 1 to 5. You can imagine what's happened to that portfolio. So the value of that portfolio that they funded with deposits grew diminished in value. They were sitting on huge unrealized losses. Plus, they had what we call cash reserves to fund deposit requests at a very low level, lowest in most of banks. Okay, so here you've got a bank that's got a high concentration of corporate deposits. All those deposits are over the 250,000 guarantee limit. So the Fed guarantees deposits, or used to guarantee deposits up to $250,000. So they're sitting on these deposits from clients who now see what's happening. Well, firstly, what started happening, the liquidity started draining out of the system as the Fed hiked interest rates. So people started, or corporates started withdrawing naturally deposits. But then they had to sell those government bonds that were running at a loss, that were sitting on the balance sheet at a loss. And that started impacting their capital. And then word got out that they need capital. And then the panic started, because then all these corporate treasurers sit there with their deposits at SVB, knowing that the bank might have to do a rights issue. And today, in today's modern technological age, on a Friday evening or Thursday evening at 11 o'clock at night or whatever, 2 o'clock in the morning, you can just go onto even your phone and switch your deposits from SVB to JP Morgan. And so they lost 42 billion in deposits over 2 days. $42 billion in 2 days, electronic, just gone. The losses on the portfolio that they had to sell at that stage was 1.8 billion losses that was going to impact the capital. So the Fed had to step in because this started spreading to all other banks that had concentrated deposit bases. Silvergate was the same, but they actually closed themselves down. Friday afternoon, the Fed stepped in and shut them down and took over control and guaranteed their deposits. It wasn't enough. Saturday and Sunday, the run continued. Investors, I suppose depositors were starting to look at their own deposit portfolios, and First Republic Bank and Signature Bank were the other two, with also quite big corporate bases, concentrated unsecured deposits or unguaranteed deposits, and so they started losing deposits as well. On Sunday evening, Signature Bank was shut down as well because of the deposit flight. And then the Fed did two things, which is very important going forward. They opened a swap window that allows a bank to sell its or to swap its assets for cash at the Fed at par value.
Okay.
Okay, so there's a problem coming later, because my bond portfolio is worth 50 cents in the dollar, but the Fed gives me $1. Okay.
How can they do that? Is that just to try and protect them from not falling over?
They're just, and it's clever because it's trying to ensure that those banks who now have to pay out these deposits are not being forced to sell assets at a loss. So those assets have to come back onto the balance sheet in the next 12 months. But for the moment, they've solved the problem. Plus, they haven't actually said they'll stand behind every bank's deposits, but effectively they will. It gets a bit more technical in terms of there were different government agencies who have to do this, but effectively they're standing behind. So I think in that regard, they certainly have stabilized the system. The deposit outflows have generally stopped. But it's the large banks with the medium-sized banks with big deposit franchises with corporate treasurers that suffered.
So Silicon Valley Bank, if I understand you correctly, in the old days, if you have a deposit with them of $250,000, you know that's guaranteed. If you have a deposit with them of $1 million, that's $750,000. If they go bust, you lose it. If there's any worries of Silicon Valley Bank, you're going to move that $1 million out as quickly as possible, and hence the 40 billion that you spoke about.
Absolutely. As you know, suddenly when there's a panic, yield becomes less important than safety. So it's nice when things are going well to place a deposit with a bank that's giving you 0.5% extra. But when you think of losing that yield becomes irrelevant. You want safety. You don't want to lose your deposit.
So the impact on Silicon Valley Bank was not really the difficult time that the tech sector has been having, given that that's where its clients primarily are, but because it had such a huge percentage of its book or of its deposits that it then went and put into assets that became almost like bankrupt operations themselves because they lost so much in value. So it just shows the knock-on effect of a bad decision.
Yeah, look, the tech demise and the tighter liquidity conditions obviously started the whole thing rolling with tech companies needing cash. Because before, cash was not a problem. Now suddenly they had to fund staff, they had to specs were having to pay money back to clients. So there was a liquidity drain out of Silicon Valley. But had SIV, Silicon Valley Bank, had a larger cash reserve, they would have been able to pay it just out of their cash reserves. But because most of it had gone into longer dated deposits, that is really where the big problem came. And that's where I think the market is wrong, in that this was an exception. This is not even, I don't think there's even 10% of the banking system like that. There are obviously banks who were taking risks, but the risks they took were extraordinary. I think it was irresponsible, and I think the Fed should have actually picked that up, and they didn't. So where we are now with the Fed standing behind the bank sector, I do think there is, obviously you can see it in the market, there's a lot of cautiousness. Treasurers of banks will be reluctant to lend because you just first want to see. So if you're going to a bank for a loan today as a big corporate, it's going to be more difficult than it was last week. So for a while, I think the system's closed down. The Fed should at their next meeting stand back and say, okay, the world is finally realizing that the higher interest rates cause losses. I mean, this is really... Everybody's been saying higher interest rates going to cause pain. Now it's starting to come. We had the liability-driven investment strategies in the UK. I don't know if you remember the UK pension funds a few months ago that almost fell over. Same problem, because suddenly they were faced with higher interest rates and their bond portfolios had devalued. You had BlackRock, who couldn't pay our commercial real estate portfolios, the property portfolios, because the property portfolios have fallen in value. And now our clients wanted to withdraw money from their property funds and couldn't. And so I think there are going to be more effects of these naked swimmers.
Northern Rock? BlackRock? Was it
BlackRock property?
BlackRock property. Because Northern Rock many years ago had a similar situation.
Quite correct. They are absolutely similar. 2008. Had built up a huge mortgage portfolio, but had geared it to the hilt and caused actually the UK mortgage bank collapse.
If you're sitting on the sidelines and having a look at this distortion, does it mean that it's a buying opportunity?
Look, I run bank portfolios, so obviously I would think so. No, be serious. If we're serious, I mean, just stand back. This is an event unexpected from outside left field. It's a very specific incident. Most of the banks have hedged those bond portfolios, have good cash reserves, and don't have that big concentration. So the rest of the banking sector should be fine. The focus shifts a bit now to the risk of a slowdown and bad debts. But again, I looked again over this weekend. The reserves that the banks have built up in terms of bad debt reserves and capital are excessive. They're huge. The banks have been telling us their loan books are clean because they've been reluctant to lend generally. So, and the valuations are now after this back to, I think it's like 1992 levels, 1992, 2008. So again, this happens after every collapse or panic. Bank shares get sold down. There's a 2 or 3 months, maybe 1 month period where there's uncertainty, which gives you a huge buying opportunity because 90% of the banks come through this very well.
So we're not going to do anything to our ETF on European banks. We're going to hold on to that one in the portfolio. I'm wondering about Transaction Capital, though, bringing it to a South African context. The share price dropped sharply after the announcement that they are hitting troubles with their SA taxi operation. It is a financial services business, although the biggest part of the business is We Buy Cars, so the second-hand car dealership. Kokkie, how are you reading this one?
Yeah, I haven't given it a lot of attention. I read the headlines. I know them fairly well. Visited them a few times, and as you know, a very entrepreneurial business, grew that strongly. And then we buy cars as well. So I think number one, the problem with Transaction Capital was its valuation. The valuation was fairly high, and in fact, it was too high. But investors were paying up for growth, because this is one of the few growth left, and most probably Outsurance and then Capitec are in the financial sector, three of the growth opportunities in South Africa. And suddenly when a player like that says, we've got a problem, then not only do your earnings fall, but your valuation falls dramatically. And then the taxi industry can't be having an easy time at the moment with higher petrol prices, higher interest rates, unemployment. So I haven't read of any problem with the loan portfolios inside it. I think it's just a shock about the future earnings. I hope so. I think so.
So an exponential company or exponential growth company that you value very highly because it's going to continue growing exponentially, it is not growing exponentially anymore. You've got to bring it back to earth again.
Absolutely.
And then Absa. Absa is another one in our portfolio. It's done very well for us. It had a little bit of a stumble with the financial or after the financial results, the share price falling there.
Yeah. I was surprised, and the main problem is obviously the Ghana and African operation, but Ghana, where the knock was bigger than expected. Again, they're a bit almost like Silicon Valley Bank. They had a large part of the portfolio there invested in government securities, and suddenly the government goes underwater, and you have to mark to market. And there's very little likelihood that you collect that back again, because the government is enforcing haircuts. I haven't kept up that last few days, and I think that actually spooked the market a bit. Absa is still very cheap. The rest of the operations are doing well. But look, make no mistake, if South Africa indeed is in a negative growth situation, a real growth situation where our economy doesn't grow, your bad debts are going to go up, and your banks are going to show slightly worse earnings than expected. And we don't know how much it is. I was surprised at the extent of the price fall. I see it recovered a bit later, but I think the market is standing back. But it remains very undervalued for a bank, and it's a very solid business. So yeah.
And paid a very big dividend too.
And paid a big dividend. By the way, just as a matter of interest, Signature Bank, the one that went into receivership on Saturday, was actually so confident about their capital position, they were buying back shares. So it was just the liquidity, the withdrawal of deposits. It was, and so, Absa, the same thing. Sorry, it's totally different from that. I shouldn't have made that connection, but Absa, strong capital position, a strong business, it's doing well. I think it was more the market got too excited about the net interest margins, which might be a bit more under pressure. They did a bit more, and then the loss from Ghana.
You made some rather complicated, or threw in some complicated terms around the Ghana situation, haircuts and government underwater. Just for in real simple terms, what exactly happened there?
Okay, so, well, just think of South Africa. I mean, it could become a real situation in South Africa in 10, 15 years' time, where our government keeps pushing money into Transnet, into Telkom, into Post Office, into a new government bank. So you're ratcheting up your debt. And eventually what happens in a situation like that, where Zambia was as well, Egypt is now, and Ghana was, and we potentially on our way there, in that your debt level becomes so big that you can't finance it anymore. So, and especially here in South Africa, the debt that we're creating is not creating growth. So your interest bill keeps growing, but your income, your tax revenue doesn't. And you get to a point where your government simply cannot make interest payments anymore. And then it goes to its creditors and it says, I'm sorry, I can't pay your interest this year. Maybe we can do 80% of interest payments. Or effectively what they then do, they say, I owe you 100 Rand or 100 kwachas, or I'm going to rewrite that to make it 80. I'm going to take 20% off the value of what I owe you unilaterally. Well, it's
that's
not
a haircut.
And that's a haircut. So the government actually reduces the amount it owes you.
Just like that.
And it has obviously big ramifications because thereafter nobody will ever lend to that government again, or only, well, in fact, investors are stupid. I think Argentina has had in the last 100 years 4 such defaults. And every time there's again somebody who's willing to take the risk for a high interest rate and put some money in and lend the Argentinian government money. So, but that's really what's happened in Ghana. There's a haircut. The government couldn't pay make good on its interest payments, and went to its investors that had lent them the money and said, we're reducing the amount that we owe you.
But you know where I suppose is responsible? If you're a company and you're about to hit the wall, instead of hitting the wall, rather go to your creditors and say to them, we can give you 80% of the interest now, help us through this time. But as a country, not so good.
As a company and as a country, what normally happens, and it's happening in Egypt, happening in Zambia, happening in Ghana, where the IMF obviously gets involved as a big backer, and all the investors get involved as well, are those who have lent the government or the company money. And before they agree to the restructuring, they first want to be happy with the plan that the government is going to follow. And that, they are going to start growing the economy again. And in fact, in Ghana, it doesn't matter of interest. The Chinese government, in this case, are refusing to come to the party. They want everybody else to take a haircut, but they don't want a haircut. They want to keep the full value of the dominant. And that is where the big problem has been. They can't come, the creditors can't come to an agreement at the moment. Well, I've been out of touch now for a while, but yeah.
Well, when you are in Greenland, I guess you should be out of touch. I watched Borgen. I don't know if you've ever seen that series on Netflix, but it's about. They showed quite a lot of Greenland. It's a political drama about the Danish and Denmark being Greenland. I think still is a colony of Denmark.
And it's a protectorate. I think it's
And anyway, Borgen is a fantastic series which has been dubbed from Danish. And they show a lot of Greenland, and what you showed outside of your hotel room was exactly the kind of pictures that we see in Borgen as well. Kokkie, it's so good for you finding time for us while you're on this trip of a lifetime, this bucket list trip. We really appreciate it. I won't bug you again, I assure you, unless there's another Silicon Valley bank. But Kokkie Kooyman is the director and the co-founder of Denker Capital. I'm Alec Hogg from BizNews.com.